Have you ever heard of a company that was on the absolute brink of collapse, totally buried in debt? Now, what if I told you that same company, just a few years later, was not only completely debt-free, but was also posting the best financial results in its entire history? Well, that is the incredible story of Paramount Communications. But here's the really wild part. Their record-breaking success was driven by a choice to deliberately lower their profit margins. Yeah, a strategy that sounds like it goes against everything you learn in business school.
So, to really get what's going on today, you have to rewind a bit. The 2008 financial crisis just about wiped them out. It forced them into years of really painful debt restructuring. I mean, by 2016, things were so bad that an asset reconstruction company, basically a firm that handles bad loans, had to take over their debt. And yet, somehow, against all odds, by fiscal year 25, they had paid off every single rupee, going from near death to zero debt. That's the crucial background for the really surprising story that comes next.
Okay, so with that amazing comeback story in our minds, the company drops its investor presentation for FY25. And, on the surface, the numbers look absolutely bulletproof. It really paints this picture of a company that is just at the absolute top of its game. Let's just start with the top line revenue. They brought in over 1,576 crore rupees. Now, just so we're all on the same page, 1 crore is 10 million. So we're talking about roughly 15.7 billion rupees, which is almost 200 million US dollars. This was the highest revenue in their entire history, a massive, massive number showing there was huge demand for what they were selling. And that record-breaking revenue, it wasn't just some small incremental step up. No, it was a 47% leap from the year before. I mean, in a mature industry like manufacturing, you just do not see that kind of explosive one-year growth. It's almost unheard of. It's truly staggering. And this shows it wasn't just a one-year fluke either. This chart here shows the compounded growth rate over 3 years. And while revenue growth is already an amazing 40% a year, just look at the profit numbers. EBITDA, that's basically a company's core operational profitability, it grew at over 77% per year. And profit before tax, the bottom line, it just skyrocketed, growing at 138% annually. I mean, every single arrow was pointing straight up. So everything looked perfect, right? The investor deck was just this beautiful sea of green, upward trending charts. But then came the earnings call. The part where analysts get to poke holes in the story. And sure enough, one really sharp analyst spotted something in the fine print that just didn't quite fit this perfect narrative. I mean, seriously, after seeing those numbers we just went through, record revenue, profits that are just rocketing into space, what on earth could possibly be wrong here? What was the catch that was hiding in plain sight? And here it is. This is the big twist. So normally, when your sales are booming, your profit margin, that's the percentage of profit you make on each sale, it should stay the same or even get better, right? Because of economies of scale. But for Paramount, the exact opposite happened. In their biggest quarter, as sales were shooting through the roof, their operating margin actually dropped from 9.2% all the way down to 6.6%. They were making less profit on every single rupee of sales at the exact moment they were selling the most stuff. And this is the question. The exact words an analyst used on the call. He pointed right at that significant drop in margins and basically asked management, what is going on here? You can just imagine the tension. This one question cuts right through all the good news and puts the CEO squarely on the spot. And the CEO's response is where this whole story gets really, really interesting. Because instead of getting defensive or making excuses, he explained that this drop in margin, well, it wasn't a mistake. It was the entire point. He laid out this whole philosophy that pretty much turns conventional business wisdom completely on its head. He broke it down into this simple 3-part playbook. First, he said, forget about chasing high percentage margins. Focus only on the absolute number of rupees you bring home. Second, generate that cash as fast as humanly possible. And third, stay nimble, stay agile so you can pivot your strategy at a moment's notice.
This wasn't about looking good in a textbook, it was about raw cash and pure speed. And here, the CEO, Sanjay Agrawal, he just says it so plainly. I love this quote. He admits it. Analysts love percentages. He knows they do. But then he says, but at the end of the day, you have to bring home the bacon. It's such a direct challenge to the old way of thinking. He's saying we care more about actual cash in our bank account than pretty percentages on a spreadsheet.
Okay, so to see how this strategy actually works, we need to quickly understand a concept called working capital days. Don't worry, it's simpler than it sounds. Imagine you're running a lemonade stand. On Monday, you spend $10 on lemons and sugar. On Tuesday, you sell all your lemonade, but your customer says they'll pay you the $20 on Friday. Well, that time lag from Monday to Friday, that's your working capital days. It's the time your cash is tied up. The CEO's whole plan was to make that time lag as short as possible.
And this table right here, this shows the absolutely stunning result of that strategy. By taking a lower profit margin, he was able to get customers to pay him much, much faster. Just look at the debtor days. That's how long it took to get paid. He slashed it from 86 days down to just 47 days. That's almost in half. And that single change helped cut his entire working capital cycle by a third. That is a huge amount of cash that's no longer tied up waiting to be paid. It's free, ready to be reinvested to grow the business even faster.
So what's the big takeaway here? What this story really reveals are two fundamentally different, but equally valid ways to look at a business. You can be the high-end boutique shop with really high margins and slow, steady, predictable sales. Or you can be the high-volume, lower margin, cash-generating machine. Neither one is wrong, but Paramount made a very, very clear choice about which one they wanted to be. So the real lesson here for any of us looking at a company's financials is that you have to dig deeper than the headlines. It's about understanding that trade-off between pretty percentages and actual hard cash profit. It's a fantastic reminder that cash flow is king, and getting your cash faster can be way more valuable than getting a slightly higher margin. And maybe most importantly, it shows us that the polished investor presentation tells one story, but the real strategy, the real truth, is often revealed in those unscripted questions that come after. So in the end, Paramount is making a massive bet. They're gambling that prioritizing absolute profit, incredible growth, and lightning-fast cash flow is a better path to success than protecting those high percentage margins that everyone else obsesses over. So you have to ask yourself, is this a brilliant modern strategy for a fast-moving world, or is it a really risky gamble that could backfire the second that growth starts to slow down?